Good morning, everyone. I hope you have a hot cup of coffee next to you during this very cold morning. My name is Cassie Hopkins, and I help coordinate the webinars and events for Hausman Johnson Insurance and the Benefit Services Group. I would like to welcome you to today's webinar, Top Strategies Against a Hardening Construction Market. So before we begin, we have a couple of things to go over for you. This webinar is interactive. It will feature a question and answer session as well as polls. You can type a question in at any time during the webinar and John or Bill will address it. After the webinar is over, there's a short survey we would really love for you to fill out to give us feedback on the webinar, the speakers, and any other webinar topics you're interested in learning more about. This webinar will also be recorded and it will be available on the webinar archives section of our website. And you as an attendee will receive a follow-up email with a link to the recording and the presentation slides. I would now like to introduce you to our deadly duo of speakers, Bill Nagy and John Templin. So Bill joined Hausman Johnson Insurance in 2019, and he had the move to HGI because he knew it was the right long-term fit for his professional and personal values. Bill is a graduate of the University of Wisconsin-Madison, and he also holds an MBA from Ohio University. He played football professionally for 3 years and followed up with that experience as a coach. After transitioning out of football, he began his career in the insurance industry. Bill's passions lie in ensuring people and that their businesses are in the best position possible to be successful. He builds strong, lasting relationships with his clients who entrust him with their insurance programs so they can focus on what is important. At home, Bill and his wife Jessa have 3 wonderful and, might I add, adorable children that keep them very busy. They are both former Badger student athletes as they enjoy cheering on football and volleyball teams at their alma mater. He also actively gives back to the community through the NFL Alumni Association by coaching and mentoring young athletes. Next, we have John Templin, who is our certified insurance nerd. John grew up around insurance. When he was young, his grandfather owned an insurance agency in Peoria, Illinois. Now he is one that clients put their trust in to protect their businesses that they've built. John enjoys making clients of Hausman Johnson Insurance aware of the risks that they face and teaches them how to address those risks so that their businesses can continue to thrive. John holds a Bachelor of Arts degree in English from the University of Wisconsin-La Crosse. When weather cooperates, he likes to visit the zoos in Madison and Milwaukee. John has also volunteered his time to serve as the Director of Coaching for the Middleton Youth Football Board of Directors, and he also has 2 wonderful puppies named Duke and Zora. Welcome, John and Bill.
Thank you very much, Cassie. We appreciate those introductions. I think today will be a great balance of some brains and some brawn with a little bit of balance. But yeah, JT, I'm excited to give this webinar with you, and appreciate everybody that's tuned in, and we're looking forward to it.
I am too, Bill. Hey, until I saw this slide, I didn't realize that you and I both separately wore the insurance guy uniform for picture day.
There you go, buddy. I love it.
All right, let's get it kicked off. So to get started, we'll take you through, go ahead, Bill.
Hey, JT, rock it, my man.
All right, so we're going to talk through a few things today. First and foremost, as we'll get into a little bit more, we're going to give you guys a state of the construction insurance marketplace. And as you might have guessed by the title, it's trending in the wrong direction for buyers. We'll look into some of the hard market factors and some of the impacts that that's having across the board. We'll take you in kind of line by line to a market assessment and what that means for the construction industry. Finally, we'll get into some strategies as far as game planning around successful renewals. We'll take a look at one of the key elements to it, which is modeling and managing your losses. And then when all said and done, Bill and I will get together and we'll recap 3 key points for you guys to take away from, where if you get nothing else, now at the very least, you got 3 things that you can take back to your experiences.
Absolutely. Just leading in from one of the fundamentals, just high level looking at the insurance market in general. The insurance market is cyclical, fluctuating between hard market as well as a soft market. Soft market being a time where rates fall carriers chase market share, a number of competitors, extreme competition to where rates continue to lower to a point where it shifts towards that hard market, as we've seen over the last 6 quarters. Whereas John alluded to, that's where we're at now. There's an upswing in the market cycle leading to a number of factors that we're going to touch on here at the beginning before we get into the meat of the presentation.
Yeah, so we're sort of on the red to yellow side of the diagram at this point, if you can pop back a slide, Cassie. And we have been on the other side of things for a long, long time now, but it's one of the longer soft market cycles we've seen, been about 7 to 8 years.
And with that, just there's layers and layers of uncertainty as insurance carriers look at it. A number of contributing factors, some of those directly, others indirectly to the insurance market just in general. One being claims. Claims, whether it's the cost of the actual claim, whether it's the cost to defend, the time and resources put into that. As you can see, project delays, litigation surrounding the pandemic. You start looking into some of the management liability claims that you see. 1 in 11 companies currently are involved in some type of management liability lawsuit. And as you start getting into some of the indirect, and this is when you look at how an underwriter views the business and how much work is going to be had, it is tough to project as you look at the supply chain and as you look at the cost of building materials and project schedules, as well as financing for construction projects in general too, whether that's from construction loan standpoint, but also when you start gearing into some public work and some owners are requiring some surety. How the PPP loan and the equity within each individual organization is being viewed by the surety is something to dig into as well. But ultimately, a lot of uncertainty within the marketplace as we see it.
Well, yeah, and as we saw, 2020 was a very uncertain year around the COVID pandemic, and just like the economy at large, now the insurance industry is starting to respond to that.
Some of the hard market factors, as you saw in the diagram above, and just going over those real briefly, reduction in capacity. Carriers are beginning to tighten their standards and what the appetite for each of their risk standards are. You see increased losses, and not necessarily just increased losses, but increased claims and the defense cost that goes along with that. And you see the impact of claims. Some of those standard procedures and hospitals postponing have led to increased costs and in reserve delays when you look at it at a high level, as well as the market performance. And you may say the market has never been higher, but I think it's important to note how insurance carriers invest their money and how those investment structures are what they're made up of. A lot of fixed investments, they can only have between 10 to 15% in those equities, and they need a lot of cash on hand to handle some of the claims that come up with that. So those all affect an insurance carrier's rating to play at the high level that they want to be when it comes to writing on admitted paper. But then also, and this is not a COVID presentation by any means, but there still is some uncertainty around some of the claims, and not just per construction companies or per the industry. When you share a pool of risk and you're in the guaranteed cost marketplace and you go to a carrier, you share risk with a number of different industries as well. And JT, I'm sure you can jump in on this, and whether it's hospitality, whether it's transportation, the bottom line for many of these insurance carriers, it's shared amongst many different industries. So one industry may be thriving, the other one may be suffering. And that is an impact to the hard market and some of the factors that are within it.
You're absolutely right, Bill. And so one of the main issues coming out, there have been a few class action lawsuits amongst restaurant owners that are suing insurance carriers. And even though business interruption claims for a pandemic were never intended, some courts are awarding damages there. It's not factored into the model up front, and so carriers need to stay solvent. And so that, as you say, means sharing the love and spreading the increases out throughout their entire pool of risk.
And getting into some of the conditional impacts, alluded to them a little bit, just the tightening of underwriting standards, the shifts of appetites within each individual carrier geared towards capacity, whether that's from an insurance limit standpoint, whether that's from a line of coverage standpoint, and also just looking at the class of business, whether they're staying in construction, whether they're getting out of hospitality. There's a lot of moving pieces and parts, and it's putting stress on some of these underwriting standards within the industry. And it's important. Yeah, go ahead, JT.
Sorry, Bill. Just to jump in real quick on the class of business. So there are some higher hazards, for instance, that there are some carriers that want to get out of entirely. That may have entertained some exceptions in the past as they take a look at where their book is profitable and where it's not. A lot of them are getting into sort of looking at an entire class of business. So you may be an A+ risk, but just based on what you do, there may be some carriers that aren't interested in the current market conditions in stretching a little bit. Now they're kind of contracting in and they're sticking with what they've historically been profitable with.
Oh, exactly, JT. Well said. As well as the terms and conditions within the construction industry. Looking at the exclusions, looking at some of the endorsements, policy language that are written on these policies, which are annual contracts. They change every year you renew. And I think it's important to note just construction contracts in general are always changing. And the language that is being put in there, and it's important to note the deductibles and how some of these programs are structured as well. But important to make sure on top and reviewing these as well, because there are changes and you don't want something, getting snuck under your nose on one of these as well. And JT, I'm sure you have something to add just in regard to this as well.
Yeah, so as far as policy exclusions are concerned, you may have seen with COVID, you probably didn't see a virus exclusion on your last general liability policy. I guarantee you'll see it on the next one if it wasn't there previously. Because again, insurers are trying to spell out exactly what their intent to cover is, and it's a very reactive industry. Typically, a court will decide that a policy covers something that the carrier never intended, and then they clarify their intent going forward. And so as far as higher deductibles are concerned, there are a lot of legacy programs out there where a $500 deductible on, say, a comprehensive or collision on the auto may have been appropriate with vehicle values, what they were 10 or 20 years ago. But as say, auto, as we'll get into a little bit later, is where there's a real hot spot and has been for the past couple of years. We'll get into some reasons why. And so just in terms of being willing to offer proposals, a lot of companies are requiring higher deductibles on all lines. So getting into a little bit what this is, what all these impacts are doing line by line. And again, the baseline of these is every single carrier buys reinsurance. So they insure their own book of insurance. And those base rates are going up between 6 and 7%. So they pass along as they try to, that usually winds up going to the policy holder. And as you go through looking at this line by line, again, you can see that generally where in the past soft market cycle, you might have seen single digit increases, double digits and higher are getting to be more and more common, right? So where you used to be in the teens on a high end for an average performing risk, perhaps now you're probably looking at, again, the umbrella and excess is the most extreme outlier in this chart. You may be looking at 50%. I've had some personal experiences where umbrella has had double the premium for half for the limit offering. So just one thing to keep in mind. And again, these are all national trends. Go ahead, Bill.
No, and you were getting to it, JT, but national trends and the Wisconsin market and Midwest market as a whole, fairly insulated with the number of regional carriers that get involved. So you have the balance of some of the national carriers that, from a reinsurance standpoint and from their scope can be affected a little bit differently than some of the regionals. So these are ballpark projections. Just wanted to make that point real quick, JT.
Yeah, absolutely. And as you say, if you're, if you're getting in here, this is again state of the market. Your mileage may vary. Your experience is going to dictate what your rates are, and we'll get into that as we go forward. We can go on to the next slide. All right. So taking a look, property and builder's risk are two areas that we wanted to hit on, and we paired these together as we have with the next couple of them. Just looking at it because a lot of the same factors are affecting them. For property, the reason why we're seeing the increases where we are, that has traditionally been fairly flat, but there have been a few major insurers who have gotten out of large commercial properties altogether. A lot of manufacturing facilities, there are a few carriers I can think of that no longer offer, that are trying to get off of those risks as quickly as they possibly can. When you look at the catastrophic losses we've had in the past couple of years, from wildfires out west to floods in the traditional floodplains, and then wind and hail losses, a lot of hailstorms that we've seen, and then the tornadoes seem to have a bit of an uptick, to say nothing of the hurricanes in the southeast. These have always been there, but it seems like they're happening more regularly, and so the property market's had to adjust. As far as builder's risk goes, we're seeing extreme volatility in that marketplace. I know we had some numbers thrown at you in the prior chart, but even with that, that's very much becoming a moving target, especially if you're doing wood frame construction. There are not many carriers that have the capacity and that have the interest in insuring wood frame buildings as they're going up. The rates are getting a lot higher. There's significant carve-backs on coverages, and also very significant requirements now for the kind of safety and project protection that might have been a little bit more lax in the past. The major players who are still willing to work with frame builders risk are requiring more and more.
Yeah, and JT, actually, we just had an email come through this morning on this, and you talk about some of the safety measures that are going into some of the wood frame projects, whether it's, throughout limits 10 million and above, the fencing, the detectors, the monitor detecting systems that they're starting to require just to even offer an indication and offer a rate. It's something it's important to note, because as you do the due diligence on some of these projects, builder's risk, you can't go off the benchmark that you did the project a year or 2 years ago, because as you said, it is a moving target.
Yeah, and we've seen this change month to month, and not quite week to week, but certainly it does seem to be trending in the wrong direction, and it is very much a carrier's market in builder's risk. And we can copy the next slide. So taking a look at auto and excess liability, auto losses are the things that carriers are afraid of more than anything else. And we'll get into some strategies to combat that and how you can present yourself in the best possible light to the insurance marketplace. But generally what you're seeing are social inflation losses. In terms of just generally, we're getting to be a more litigious society. Across the board, you're seeing broader contract interpretations where, again, as I alluded to with the COVID-19 stuff, it's entirely possible that the two parties intend one thing and a jury or judge interprets another. And so that can lead to some complications with claims. The big issue that typically happens on the auto more than any place else are what are called nuclear judgments or nuclear verdicts. The carriers will refer to these as anything above 10 million. And where it used to be, you get a handful of them every year, they're getting more and more common. The biggest one that's out there that I can think of that happened last year was a trucking firm down in Georgia. Got a $280 million verdict against them, which included $100 million in punitive damages. It was a particularly egregious case, but the thing that's important there are elements of distracted driving, elements of having unqualified drivers, are things that if the worst does happen, a jury's not going to interpret it favorably. And then finally, in third-party litigation, you're seeing some third-party financing of fighting and advocating for claims. And so as a result, as we've said, the carrier capacity has really shrunk over where that is. That the rates have climbed sky high. And the other thing to keep in mind, so you'll want to allow a little bit more time to go through your insurance renewal process than you have previously, unless oftentimes, as you would expect, when you see the increases where they are, they're estimating that 65% of umbrellas are projected to be marketed or to be shown to other carriers at the 2021 renewal. Now, so there's going to be heavy competition, and there's just not the underwriting capacity in the market.
And with that, JT, so 65% of umbrellas projected to be marketed. I think I saw 85 are expected to stay in the same spot. So there's
another great point.
But there's not a ton of competition out there. So when you pull it back to the basics of, just economic supply and demand, there's not a lot of capacity out there for carriers to take on.
That's exactly right, and that's why having a strategy is important, and that just shotgunning it out to the market and trying to get indications from 10 different carriers won't drive the best result for you.
Right, just having that strategy behind it, and we'll get more into that further into the webinar.
All right, and then a couple other lines. So professional liability, as Bill mentioned, there are 1 in 11 companies that have some sort of management liability claim ongoing currently. Social inflation is a part of that, so employment practices and some lawsuits that have merit. And the other thing is there's a lot of concern around companies developing, implementing, and being consistent in their COVID-19 messaging and policies. And so as far as in our experience, I can say anecdotally, this is probably a line of coverage that I would say most people have the least understanding around.
And it goes down a number of these claims, whether there's merit to them or not, whether it's, he said, she said, you name it, the way that insurance carriers look at it, when you look at the statistic of 1 in 11, they're essentially ensuring the rate of the likelihood of them having a lawsuit against them, right? Because within that and within many of these policies, the duty to defend is going to be the largest expense. So that's where these are, I think 10 to 25% is fairly conservative. And this is from an industry standard, but in other industries, it's absolutely going crazy as well.
Well said. And from a surety standpoint, as I say, we've got surety experts in-house at Houseman Johnson. I think Bill and I know enough to be dangerous, but talking to people smarter than us, everything we're hearing from them is that the underwriting standards have gotten a lot more strict than they had been in the past. And one of the most important components is as the surety gets into your financial statements, they're going to ask questions about what kinds of projects are you doing? Are you possibly diversifying into a place where you don't have a ton of experience? How are you handling less work out there? Again, a lot of these sureties have memories from the 2008, 2009 crash. And the companies that were in the most trouble weren't the ones that weren't getting enough work, but the ones that overcommitted themselves. So they've got their finger on the pulse there and just want to be sure that, again, a surety is there to back up and make sure that all your work gets done. They don't want you to be overcommitted.
Absolutely. The surety wants to understand what your identity is as the competition starts to scale down and some of the larger self-performing contractors are able to come down. They don't want people getting outside of their traditional scope of work. So this is something that's heavily surveillanced moving forward. But yep, next slide, please. And this is ultimately, where it comes to life. We gave you the state of the marketplace, a little bit of background information just on the hard market in general, but this is about the strategies, the tips and strategies moving forward, coming up with that game plan for a successful renewal. Ultimately, coming down to just the fundamentals, the communication, timing, transparency, many items that people take for granted. It's just know what your experience says about you within the marketplace. Understand how carriers are viewing your business, and also coming up with the plan. Start that process early, as JT said. Don't want there to be any surprises with it. Ask those tough questions on the front end and be proactive opposed to reactive when it comes to this. And fairly fundamental, but important to note. This is going to come at all businesses. It doesn't matter how well the experience is. As JT showed in the diagram and the statistics, this is affecting everybody. But evaluate where your firm is on the spectrum of risk. And when we talk spectrum of risk, it's anything from a guaranteed cost marketplace to where if you place your insurance with a carrier in the traditional marketplace, to you start going further down that spectrum of risk to alternative type programs, whether it's higher deductible, whether that's captive insurance programs, understanding the why. Consider those alternatives, but understand at the base level what your risk tolerance is and what your company's appetite for risk is and what the goals are surrounding that. JT?
Yeah, so just to hop in on the spectrum of risk real quick, that if in a softer market, it probably makes sense. If you got a lot of carriers that are willing to insure you very cost effectively, it probably makes sense to cede as much of that risk as you can. If you feel like you have yourself pretty well under control, maybe now's the time to take a look with the market hardening up and capacity starting to dry up. Maybe you retain some of that risk strategically.
Yeah, and just knowing what you're transferring to an insurance carrier, what you're taking on yourself, what you're contracting or what you're transferring via contract, just knowing there's no program that is good or bad without truly understanding what your risk tolerance is and knowing what you're retaining and what you're transferring. But that leads perfect into, strengthening the relationship with the current carrier, but taking time to get to develop new relationships as well. And in the soft market, as JT alluded to, in a soft market, you have 10 different companies competing for your business and throwing crazy rates. And at that time, you're like, oh, of course, absolutely, there's carriers that want to compete for our business. Yeah, we have a backup carrier. Of course, they offered an indication 3 or 4 years ago. The times have changed, so it's important to develop that number 2 or that backup carrier, as we call it, and also just reviewing the past marketing efforts and being strategic around that and how and when those carriers have been approached. Because not getting too far into the weeds, but there's a strategy as to who you approach and when you approach these carriers.
Yeah, and just to hop in on it, as far as from a carrier standpoint, your best result is going to be a carrier that understands you, understands your business, and has a comfort level that the worst losses out there in the industry aren't likely to happen to you through the controls that you've put in place. And we'll get into that a little bit going forward.
Yep. Next slide, please. Perfect. Looking in the mirror, understanding your company's culture, and some of the best tools can be, within. And you want to look to a carrier, want to look outside to a third party, but just the onboarding process and the training that you can implement yourself and the investment within your own people from an engagement, retention, as well as wellness. And we talk about some of those management lines of coverage. You talk about other items that can happen. If you have an engaged workforce, the likelihood of some of those claims and how those claims are handled, it can be a huge differentiator. And just getting that buy-in as you look at, what the true company culture is. And we touched on, go ahead, JT.
Say from a high level, just in terms of a management liability claim, and it makes sense, right? I am not going to sue an employer that I feel like cares about me. I'll have a conversation with them and we'll address things that way rather than getting attorneys involved and negatively impacting our financial experience going forward.
Right. And stuff's going to happen. There's no question about it. But just as you look at something that you can control, this is an item that feels important to focus on, as well as the next 2 bullet points. And we touched on these briefly, is just evaluating projects as well as the project schedules, doing the due diligence on the front end and understanding, what that builder's risk marketplace is like. That can impact whether a job is profitable or you're going to lose money on it. Understanding, how long, and having that negotiation and that discussion with the ownership groups on the front end from a project extension standpoint, and looking at the supply chain, understanding how long that job could potentially take and the implications on the insurance program as well. It's important to do that work on the front end. But also understanding who you are. And we talked about this when we brought up the bonding. Just value your own work. You don't have to bid on everything. Stretching on bids, changing the scope of work that you traditionally do. If it's a commercial contractor and all of a sudden we're going to start doing some multifamily work, or we're going to stretch and do some residential stuff. These can affect insurance spend, and it can also affect how carrier partners view your business as well. And on top of it, it will affect the rates.
All right, so this is the biggest tool that we'll get out of today. The most important thing, if you don't already understand this, we've tried to simplify as much as we possibly can. This is where the rubber meets the road, and this is where the numbers start to come into the equation. I know we've talked in broad strokes on a lot of these items before, but the most important piece is to understand you, think like an underwriter, and to understand what your loss ratios are and what that says about you. So the simplest thing is understanding a loss ratio. It's just a simple calculation of the premiums you paid in divided by the losses incurred. And now by incurred, I don't necessarily mean everything that's paid out. That's anything that's paid out plus what the carrier is reserving because what they think is going to need to get paid out on. So for instance, in the simplest terms, say you're paying $100,000 in premium and you've had $10,000 in incurred losses over the past year, that's 10% loss ratio for that year. And so what's important is to know what's profitable for an insurance carrier. You want to be profitable because when you do, that's when even in a harder market, you can get some competition and when you can drive the best results. So their break-even point for most lines is usually around a 60% combined loss ratio. And the thing that you need to know, are you profitable? Are you a gamble? Do you have to lean back on some prior good experience to get some goodwill from your carrier going forward? Just knowing the state of the marketplace and knowing that now probably isn't the best time to push if you're a substandard risk. And it's important to know how carrier is going to analyze the changes to your business, as well as to understand the successes you've had in the past. This is the time when you need to make sure the carriers understand your long track record of success if you have one, and understand exactly what you're going to do to fix it if you haven't.
Oh, exactly, JT, and that was very, very well put. And ultimately, this is not just a look at the loss runs, come up with a percentage. This can be used as a leveraging tool in the negotiations. If you are a well-performing and a profitable opportunity and partner to that carrier, and just knowing if you're being penalized by other businesses just being in the guaranteed cost marketplace with whether it's other industries, other business of class, it's important to know that one, when looking for a partner as a backup carrier, but also evaluating the renewal that you have in place as well.
Have the next slide, please. All right, and so the important thing is a carrier wants to know whether you're trying to manage your own risk or whether you're just a buyer of insurance. At this point, they could be more selective, and they're looking for companies that are going to proactively manage their own risk. So again, we've given webinars on a lot of these things before, but just at a high level. Before a loss occurs, the stuff that they're going to want to know, the stuff that you're going to want to make sure you're clearly communicating, are that you have a thorough training and onboarding process, right? That you take your time. There is they've done some correlational studies between the amount of training time and the likelihood of, it's typically work comp losses. And they've found that there's a really strong connection between slowing down on training, even with people who know what they're doing, and making sure they understand the way you do things. And the more you just throw them out there, the more likely a new employee is going to be to try to impress you with how much they can do. And they might take unnecessary risks and do something dumb and wind up hurting themselves, wind up causing damage. Right? So take your time with training. Think about formalizing those processes in ways that you haven't in the past, perhaps. And I know that nobody has more time these days, but this is where it's worth investing if you do. Right? Taking a look at what you're currently doing from a training standpoint and beefing that up, and also making sure that your insurance carrier knows what changes you've made and knows what you're doing. What kind of on-site and off-site risk mitigation you've got. That could mean having a safety director hired that's in charge of it. Could mean having a safety committee if you haven't formed one in the past. There are any number of resources there from both a carrier and an agency standpoint that you're going to want to make sure that if you've utilized, you want to make sure a carrier knows that, and that you have everything well documented. Contract review process. This is where I spend a lot of my time. If I had the patience to go back to school, I'd think about being an attorney, but I just am sort of an amateur one as time goes on, and enjoy reviewing the contracts. But as you look through, what always surprises me and what makes it such a fascinating area to focus on are the way that the provisions and contracts are changing, and how just slightly changed wording means something completely different in terms of who's taking the risk on a project. So it's important that you've got a process in place for how you're signing owner contracts or general contractor contracts if you're a subcontractor, as well as knowing what your own subcontract says and making sure that there's alignment there and that you're not retaining everything you don't intend to. It's important to have.
JT,
Yeah.
I was just going to add, and you're an expert with this, making sure that the insurance program responds and meshes with the contracts that you're signing into as well. Obviously, the contract and the intent of the contract from who's retaining what, but understand, what the coverage states and what the policy actually says as well. So there is not a breach of contract situation. And that's an item that, when we review these and review risk management programs, something that we run into a lot more common than many think.
Another great point that typically attorneys aren't particularly well versed in insurance, and we in insurance are not attorneys. So whenever you come up with a contract and you are coming up with insurance as a risk financing mechanism for the contract, it can be difficult to make sure that those things mesh perfectly. And that, as you say, Bill, is where we spend quite a bit of time. It's important to know that, and it's important to do this prior to a claim, but having reporting procedures. If something happens on site, what's the chain of command? Who's the central contact? And how does that get reported to a carrier and to an agency? And also knowing what your handling expectations are from a carrier standpoint. Return to work plans if you don't currently have them. I've done other webinars going into financial management of work comp claims, and return to work is a major component. So if you don't have it currently, it's something to absolutely look into. And finally, and importantly, if you feel like you've got things pretty well in hand, it's not a bad idea to invite the carrier in that you're working with and utilize their resources, right? They'll offer them to you. The flip side to it, though, is keep in mind anything they see likely will get reported to the underwriter, good or bad. So if you're a great risk, probably doesn't hurt to have loss control from the carrier if you've got time. Come out and take a look at you and vouch for all the good things you're doing.
Absolutely. Utilizing those resources and negotiating those resources on the front end. Be proactive as to reactive with those, as well as from an agency standpoint too. Just make sure those discussions are handled up front, so it's not asking halfway into the year, and many are pretty well versed and can cater to that too. But having that plan on the front end is always helpful and can make the relationship a lot smoother. And minimizing the impact of losses. And this is digging into the weeds a little bit based off of, what it is from being a risk manager to an insurance buyer. And really the cost of mismanaged claims and how long those can stay on reserves and how they can affect, your work comp mod. And it's not something that will affect you just this year. It's something that can affect you for the future, right? So these claims and how they're managed and how they're advocated for, whether that's internally, whether that's with the agency partnership. And it's important when evaluating a partner from a carrier standpoint and understanding how they view claims and getting a chance to meet their team outside of it. That's important too, because mismanaged claims can lead to a number of extra expenses, not just the bottom line premium as you go through the renewal process year in, year out. But it's important to make sure that stay on top of all those losses and review those, whether it's quarterly, semi-annually, coming up with that plan, whether it's with the carrier, whether it's with an agency internally, coming up with a strategy to make sure that you can close out those claims and make it as efficient as possible, or whether it's a plan to fight those claims. That just having that plan and making sure there's a good foundation, coordination and communication. That's what it's about, and just being fully transparent.
All right, so to wrap things up, appreciate you guys staying with us this morning, and we'll hop into questions momentarily. But so the things that you've got to know, if you don't take anything else away this morning, realize that we've been in a softer market cycle for the past 7 to 8 years. Nationally, that's hardening up. Regionally, yet to be determined. We are seeing some of that starting to filter through, but that may take a little while to hit us in Wisconsin. But all the same, need to know the current conditions are absolutely trending toward an insurance carrier's market, especially in the umbrella and excess. If you're carrying a high limits there, you'll likely see a more challenging renewal there. And most importantly, carriers want to be partners versus vendors, and they have the ability to become a lot more selective in who they work with and who they price more aggressively. Right? Even the best-in-class risks are taking some increases for the time being, but good experience and good track record with a carrier can help you blunt some of those. And so you just need to make sure that you're advocating for yourself and that your agent's advocating for you as well. This seems pretty straightforward and pretty simple, but the best results are going to be attained by allowing adequate time to take a look at everything and commit to designing a pre-renewal strategy. And again, in a softer market, that's a little bit of a simpler task, right? If you got a bunch of people coming to bid and everybody's sharpening their pencil trying to get to work with you, that's completely different from now the onus is on you a little bit more than it has been in the past to tell a carrier, here's why we're a great partner. Here's why the worst potential losses aren't likely to happen to us. And here are the great things that we're doing to make sure it stays that way. Right. So make sure you're giving yourself enough time to design, to evaluate, to implement changes to your overall risk management strategy, whether that's looking at different deductibles, whether that's looking at there was somewhere else along the spectrum of risk. But Bill, it sounds like you got something here too.
Sorry about that.
No worries, man.
Wrap that bullet up. But just looking on the other side of the table, when you look from a carrier's perspective, they're not going to deliver bad news to you with time for you to switch things off, right? As much as, we have great relationships with carriers as well. If they're going to increase XYZ line of coverage 25%, if they're not communicating to you early, they're going to hold on to it because, quite frankly, time works in their favor. And they're in the business to make money as well. So getting ahead and asking those tough questions is important. Because it's not going to be the classic, show up 15 days out. Yep, here's the renewal. And you show and you're going to see the increase. That's too late. Just getting ahead of it and just emphasizing that couldn't be more important, especially trending into the hard market that we are in now.
Absolutely. Very well said. And then finally, the most important thing is to understand how you're perceived as a risk in the insurance marketplace. And figure out how to make a carrier understand. Work with your agent to make sure that you're leveraging all your strengths, and that when it comes down to it, if there are some areas that you're not doing as well, say fleet management, say you're not doing a great job of pre-checking your drivers, any number of the things we talked about before. If you can articulate an improvement plan and say that you're aware of it, management's buying into it, and will be better going forward, and the results are going to dictate that. Those are all important things to make sure you communicate to get the best possible result in the insurance market hardening.
Absolutely.
All right. Thank you,
and
guys.
With that, we'll open the floor to questions.
Yeah, it's officially question time. I know a couple of you have sent some things in over the course of the presentation. So if there's anything you've had a question on, pretty much from the beginning to now, Bill and John are available right now to answer those questions. So if you just want to submit them in the questions or in the chat, you can do either. So our first question is, will carriers look at a loss ratio on an annual basis or over time? Seems like a company could have a loss in 1 year, but have a profitable over time.
Yeah, Kathy, great question. So typically with carriers, as it is any place else, what carriers typically will go by is, what have you done for me lately, right? So the more recent losses are going to carry weight because they believe those will have higher predictive value going forward, especially if there have been significant changes one way or another, if they're seeing a trend in the wrong direction. Typically, most carriers will take a long view of you. And if you have one bad year, all right, that's about average. Typically looking at a 5-year snapshot of most companies, they'll have one really, really good year, one really, really bad year, and 3 somewhere in the middle. So I don't know if that helps to answer that question, but both matter, but go ahead, Bill.
And taking it to another level too, they do evaluate those year in, year out. They also evaluate a number of other factors as to marketing strategies and marketing efforts. If it is, one of those where it's bid and quoted and shopped every year, every other year, and they're going to market, they're going to look more short term because they want to know within that narrative, how it goes back to, are you an insurance buyer or are you a risk manager? Because the last thing an insurance carrier wants to do is take a gamble on somebody that they're only going to work with for a year, 2 years, short term. And over the course of time, yes, it's going to be a great partnership from a loss modeling standpoint, but anything can happen short term, just period, from a catastrophic standpoint, to where they want to look at it just of, what the tendencies are and what the habits, and if there's a true strategy behind it, or if it is just the traditional bid and quote process that they go through.
Great answer. Next question is, how long does a bad claim affect my bottom line if I am entering a hard market?
Also, the simple answer and the thing that we'll have to right away is work comp. Right, so a bad claim is going to sit on your work comp mod for 3 years. As far as the other lines, your mileage is going to vary. It's really going to depend on the carrier. It's going to depend on the circumstances surrounding that claim. It's going to depend on how you've responded to it and essentially how you've protected yourself from it happening again, and how well you can articulate that and how committed you are to a solution.
Okay. Any last takers before I close it off for questions?
And if there are any other questions too offline, don't hesitate to reach out. Love to connect and dig more into some of the details as well. Try to keep it high level, but give some great strategy around it too. So hopefully that it was impactful for everyone that tuned in. I know I enjoyed, JT and I enjoyed putting it together, and appreciate you, Cassie, and everybody that attended as well.
Well, thank you guys. And thank everyone for attending. Thank you guys so much. Once the webinar is closed, you're going to get a short survey with your feedback that we're really hoping you can fill out for us. John and Bill would love to hear how they did and what you liked, what you didn't like. And we hope that you can join us for our next webinar, which is the 5 most common compliance mistakes made by employers. It's sure to be a good one. So with that being said, thank you guys for attending our webinar, and we hope to see you soon.